Navigating the economic storm, the impact of high UK government debt. Introduction. The United Kingdom faces a daunting economic landscape, with government debt levels raising eyebrows both domestically and internationally. Official figures peg the UK's government debt to GDP ratio at 101%, but when we peel back the layers, the situation appears even more complex and challenging. Unfunded state pensions liability stands at a staggering $4.8 trillion, or 224% of GDP, and there's an additional $1.2 trillion in unfunded public sector liability, equating to 55% of GDP. These figures paint a picture of a nation on the brink of an economic storm. On top of this, the number of economically inactive people in the 16 to 64 years age group is 21.8%. This is due to the generous Social Security benefits offered currently. On top of this, the population is aging and the percentage of people over the age of 65 is 18.4% and projected to increase further. This will put enormous strain on the economically active people who will face much higher taxes, and there will be a temptation to leave the workforce early or go to other countries. This will create a vicious cycle. This is the reason why the current government is very careful about spending money in spite of the looming elections. Decades of underinvestment in infrastructure, education, and healthcare has left public services creaking. UK is no longer the country it used to be 40 years ago. The bureaucratic planning system means that the UK has one of the highest house prices in the world because very few houses are being built for the size of population. This puts an enormous burden on the young people's financial situation. Many people would like to point out that the problems are due to Brexit. But in our opinion, this is not the case. On the contrary, many decades of being within the EU has made UK less competitive from complacency. Let's delve into the consequences of this high debt level and explore strategies for individuals and investors to navigate the impending challenges. Consequences of high UK government debt. Tax implications. High debt levels could necessitate tax hikes across various sectors, impacting taxpayers directly. Higher income taxes, increased VAT, or new taxes could be on the horizon as the government seeks revenue streams to service its debt. The UK government will have no options but to raise tax. But the problem is, the current tax burden is already the highest ever, and increasing the taxes will only encourage younger people and highly skilled people to migrate to other countries, making things even worse. Public service reductions. With a substantial portion of government revenue going towards debt servicing, public services might face cuts. This could result in decreased quality or availability of healthcare, education, and infrastructure development, directly affecting the UK populace. This is already happening across UK, and the general standards in healthcare and education are falling rapidly. Inflationary pressures. There's a risk of the government resorting to monetizing the debt, effectively printing money to pay off obligations, which could spur inflation. Inflation diminishes the purchasing power of the pound, impacting savings and living costs. As everyone can attest, this is already happening, and UK had one of the highest inflations in the developed world. Interest rate volatility. The perception of the UK as a higher-risk borrower could elevate interest rates, affecting mortgages, loans, and the broader economic environment. This is a real possibility in the future, and we encourage investors to fix their mortgages to as long as possible or pay off the mortgage debt as soon as possible to protect themselves from high interest rates. Buy-to-let investors should be careful not to over-leverage themselves, as if this were to happen, there is a real threat that they may lose their properties if they are not able to cover their mortgage liabilities. Economic growth constraints. High debt can crowd out private investment, limiting economic expansion and job creation. This could result in stagnant wage growth and limited employment opportunities. The general quality of life that people have come to expect will fall dramatically. Peter Hitchens has already pointed this out. He says that UK is already a poor country. Intergenerational burden. The debt today lays a financial burden on future generations who will bear the brunt of repayment, potentially limiting future government spending and economic growth. There is also a real possibility that future generations might revolt on this cumbersome burden imposed on them, and they may elect a government which might be more willing to cut the pensions of the older generations. Advice from Muffet Investments: don't rely solely on government pensions in your old age. Investor confidence. Sky-high debt levels can erode investor confidence, potentially leading to reduced investment in the UK, impacting economic growth and employment opportunities. Navigating the economic storm. Diversification of assets. In light of potential financial repression and capital controls, it's wise for individuals to diversify their holdings, including having funds in overseas accounts, to mitigate risks associated with the UK's economic policies. Financial repression is a term used when the government tries to inflate away their debt by keeping the interest rates below the level of real inflation. This will enable them to inflate the debt away and pay lower interest rates on their borrowings than inflation. Capital control were real until 1980. This means that you will have to have permission to move money outside of UK. One of the greatest minds in finance, Mr. Russell Napier, says this quote, "The government will pluck one feather out at a time." So planning ahead for financial repression and capital controls are crucial for investors. Mr. Napier says that the money should be kept in countries which have lower debt levels and so less likely to have financial repression. Investing in dollar-earning companies. With the pound's value potentially under pressure, investing in UK companies that earn a significant portion of their revenues in dollars can offer a hedge against domestic currency devaluation. The pound had an average inflation rate of 2.17% per year between 1776 and today, producing a cumulative price increase of 20,438.21%. This means that today's prices are 205.38 times as high as average prices since 1776, according to the Office for National Statistics Composite Price Index. Furthermore, than can be sudden devaluations in the currency, as is happening in Argentina and Venezuela. Seeking financial advice. Given the complex financial landscape, seeking advice from financial experts can help individuals and businesses make informed decisions, optimizing their financial strategies amidst uncertainty. Long-term planning. Focusing on long-term investment strategies can help navigate short-term economic turbulence, emphasizing sectors and assets less susceptible to economic downturns or government debt challenges. Staying informed. Regularly monitoring economic indicators, government policies, and global economic trends can provide insights and aid in making timely financial decisions. Conclusion. The UK's economic outlook, shadowed by towering government debt, calls for cautious yet strategic financial planning. Individuals and investors alike need to brace for potential tax hikes, service reductions, and inflationary pressures while exploring avenues for asset diversification and prudent investments. As the UK navigates this economic storm, awareness, preparedness, and adaptability will be key to weathering the challenges ahead, ensuring financial stability in an unpredictable economic environment. Call to action. Stay informed, stay prepared, and explore strategic financial avenues to navigate the UK's economic storm. This will be the first in the series of videos to be produced by Muffet Investments on the current economic climate and the impact it will have on ordinary people's life. We will also cover stocks that we think will thrive during this difficult period. For more insights and updates, don't forget to like, share, and subscribe. The coming financial repression will be one of the future topic at Muffet Investments. So please stay tuned.